Chapter 7: Corporate Valuation and Stock Valuation. Topics in this chapter include features of common stock, valuing common stock, dividend growth model, free cash flow valuation model, market multiples, and preferred stock. Common stock, owners, directors, and managers. Common stock represents ownership. Ownership implies control. Stockholders elect directors, and directors hire management. Classified stock. Classified stock has special provisions for each class, usually involving voting right and dividend right, usually named as Class A, Class B, etc. Different approaches for valuing common stock. Free cash flow model include constant growth model and non-constant growth model. Dividend growth model, constant growth model, and non-constant growth model, using the multiples of parables forms. The free cash flow valuation model. Free cash flow is the cash flow available for distribution to all of a company's investors. It's generated by a company's operations. The weighted average cost of capital is the overall rate of return required by all of the company's investors. Value of operations is the present value of expected future free cash flow, discounted at the WACC, or weighted average cost of capital, is the value of a company's operations. Forecasting free cash flows, a simple approach. Forecast the sales to grow at choosing growth rates. Forecast the net operating profit after taxes, or NOPAT, and the total net operating capital, or OPCAT, as a percent of sales. Value drivers. Value drivers are the inputs to the free cash flow valuation model that managers are able to influence, including sales growth rate, operating profitability, capital requirements, and the cost of capital. Value of dividend-paying stock is the present value of a dividend discounted at required return. It can be expressed in the following formula. Conceptually correct, but how do you find the present value of an infinite string? Suppose dividends are expected to grow at a constant rate, GL, forever. We can use the following formula to calculate the dividends at different time periods. What is the present value of a constant growth dividend when discounted at the stock's required return? Constant dividend growth model assumes that the growth rate is constant and less than the required rate of return. Then the dividend will converge. We can use the security market line to calculate required rate of return. for the following example. Using stock price multiples to estimate stock price. Analysts often use the PE multiple, the price per share divided by the earnings per share. Problems with market multiple method. It's often hard to find comparable firms. The average ratio for the sample of comparable firms often has a wide range. Preferred stock is also called a hybrid security. It's similar to bond in that preferred stockholders receive a fixed dividend, which must be paid before dividends can be paid on common stock. However, unlike bonds, preferred stock dividends can be omitted without fear of pushing the firm into bankruptcy. The value of preferred stock could be expressed in the following formula. The price is the dividend divided by the required rate of return of preferred stock.